I'm Charlotte McLeod with investingnews.com, and here today with me is Danielle DiMartino Booth, CEO and Chief Strategist at QI Research, and she's also the author of Fed Up, an insider's take on why the Federal Reserve is bad for America. Thank you so much for being here. Great to have you.
It's great to be here. It's never a boring day in my life, it would seem. So today's no exception.
Yes, it's an extremely timely conversation right now because we have Powell on stage, I believe, as we speak at this moment. Some initial headlines already coming out as people digest what he's saying. So we'll start there. I had to turn him off to come on this call. So what are your initial takeaways from his comments there?
I think that Powell is reiterating and staying steadfast to his message that while inflation is coming down towards the Fed's 2% target, that it's on a very bumpy path, that it's not happening overnight, and that the Fed is able to be patient in their monetary policy making. So he's very much reiterating the economy is strong, so many of the other things that he's maintained for so long. And I think the idea here is not so much to hang on to every single word he's saying about the economy, but rather to understand that he's retaining flexibility and does not want to be pigeonholed into saying, okay, there was one report that came out and therefore we're going to do this. I don't think that's his aim. I do believe that the Fed will go forward in December. And I think that they want to get that first 100 basis points out of the way, because I think that they think that the level of interest rates was too high. So getting from, say, 5.5% to 4.5%. But the messaging really is we're going to be able to take our time and pay attention given the data that subsequently is released.
Right. So these comments that we're getting today are building also on comments that we got last week when we had the Fed meeting. And although that's a week ago at this point, I wanted to touch on it because I think it got, at least to a degree, overshadowed by the U.S. election. So wanted to check in with you there and see if there are key takeaways that you think people might be overlooking with all the activity.
I think that the takeaway from last week's meeting, at least in my mind, is that Powell wanted to be very resolute in defending Fed independence and the fact that the Fed was not a political institution. It would not be swayed by a lot of the hysteria and speculation that followed the election immediately, and of course has since continued to build. He has been forthright today in saying that the level of national debt is too high and cannot be maintained. So he's reiterating that stance. And of course, a monkey could agree with that we've simply got too much debt. But I think his reiterating that position is also making a statement about we're not going to, as an institution, enable the federal government to continue piling debt on by keeping interest rates at inappropriately high levels.
Right. And also he was very adamant in last week's comments about how he won't step down if he's asked to by Trump. And in fact, saying, that's not legal. That actually can't happen. So curious to get your thoughts there as we head toward a second Trump presidency. Are we likely to continue to see them to clash as that ultimately plays out? Is Trump likely to take a step back? What are your thoughts?
Well, Trump has already actually came out and said that he doesn't plan on firing Powell. Not that he agrees with everything he does, but Trump's memory is probably not so short that he doesn't recall his first term. And, though the media hasn't really touched on this very much, the Brookings Institute put out a really good explainer several years ago that went through Supreme Court precedent back to when FDR was in office that suggests that the precedent would be that you cannot remove without cause the head of a federal agency. And that is what Jay Powell is. And posthumously, the Supreme Court ruled that FDR was wrong in having done that and reinstated the head of a different type of federal agency at the time. But we as market watchers, as investors, as people who follow the economy very closely, we tend to forget that Jay Powell is an attorney and very much understands the Supreme Court precedent. And when he makes a statement about the legality of something, we have to bear in mind this is coming from a lawyer, from Jay Powell, Esquire, and that he understands the law. And he is right in saying, I cannot be removed from my office. What would happen if that was attempted is that the members of the Federal Reserve Board in Washington, D.C. could opt to keep Powell in his position until the Supreme Court ruled on whether or not that had been a legal step taken by a president. And by then, you'll probably already be at May of 2026, and it will be an irrelevant moment in history, if you will. So he's extremely grounded and correct in stating the illegality of removing him from his position. And I think that is why he was as resolute as he was when he was asked not once but twice, can you be removed? And both times he simply said no.
I think that is really important context just to know the background there. I was going to ask you, is it worth considering who Trump might prefer over Powell? But it sounds like really we're going to have him until 2026. So we can think about that when we get there.
But and it won't be very long before we're having that discussion, because within a year's time, there will be speculation bubbling about, because you have to name somebody in time for somebody to be replaced, and May of 2026 will roll around before we know it. So we'll know by this time next year, there'll be a handful of contenders jockeying for the position. Yeah. And that will be something that Trump will be asked about within a year's time, I would suspect.
Right. And so looking forward into the next year, you mentioned the December meeting for the Fed and getting that 100 basis points under their belt. What are you thinking further out? I know it's difficult, lots of uncertainty right now to look so far in the future. What do you think the path is for the Fed, though?
Well, I think that policymakers have been very in tune with the job market over the last several meetings, whereas the year prior, they were very much solely focused on their inflation mandate. I think that most Fed speakers who've come out since the Fed met last week have been vocal in saying we're going to bob and weave depending on what happens, not just with inflation getting down to our 2% target, but also whether or not we're seeing continued degradation in the labor market or improvement or just a steadying thereof. Today we had a large auto parts vendor, retailer in the United States announced that it was going to be closing 700 stores. We've got, we only had about 50,000 layoffs announced in the month of September. So that was certainly a reprieve, if you will, in terms of job cut announcements. But that popped right back up, according to MacroEdge, to 109,000 in October. And we're trending towards another 100,000 in November. We know that the Boeing layoffs, 17,000 of them are going to be made permanent. Stellantis, another car maker in the United States, is pursuing also aggressive layoffs. So at some point, I think the Fed is correct in keeping the door open to seeing these rising numbers of layoffs manifest in the jobless claims numbers and in a rising unemployment rate, and that therefore they should maintain flexibility going into 2025, because there's nothing to say that inflation's not going to keep coming down at a slow pace, whereas the unemployment rate could very well continue to tick up. It's at the very cusp of 4.2% now, off of its 3.4% low.
Right. Following you on Twitter, I see you tweet pretty frequently about these layoffs, and some of them, as you mentioned, at large companies. I think with Trump now being elected, heading toward that second term, there is a feeling that this is going to be good for business. So what is your take on that?
Well, I think the idea of deregulation is certainly a positive for corporate America. If after the political capital is expended to extend the 2017 tax cuts, and that is a critical step one, that's not going to happen overnight. There's going to have to be negotiations. It's going to have to be funded and paid for. But I do think that if we do get to a lower corporate tax rate of, say, 15%, as has been proposed, that would certainly be a positive for U.S. companies. But the reason I am drawing out my answer is because none of this is going to happen overnight. And the extension of tax cuts is going to be beneficial in the sense that it doesn't hurt for them to actually sunset as they would have had Trump not won the election. But it's not going to be additive at the margin for U.S. companies. And we're continuing to hear one after another indicate that they are guiding down their revenues. And of course, sales is not something that is in the control of U.S. businesses. And until they see a cessation in declining sales trends, they're going to have to continue with their cost-cutting measures. So while this can be a long-term positive for companies, I don't see an immediate end to the virtual pink slips that are being handed out. And certainly that's not been indicated since the election, because we have seen, again, a continuation of these job cut announcements, which you can certainly follow on my Twitter feed. Yes.
Yeah, I think it's always worth a reminder that things take a while to play out. We're so used to that instant gratification, seeing things right away, but that doesn't always happen, especially in circumstances like this. So one point that I wanted to go back to, you mentioned the Fed has shifted away from being so concerned about inflation, now more toward employment. One other thing that I've heard reiterated since Trump was elected is, okay, that he has talked about could be inflationary. So I wanted to get your thoughts on that as well.
Well, so I think right now this is the great unknown, is what the effect of potential tariffs would be. So there's a lot of ifs and then whens in this conversation, and it really will depend on who he chooses to be his Treasury Secretary. If he decides to go with what the betting markets are suggesting, a Scott Bennett type, then Mr. Bennett has proposed that companies are given kind of a two-year runway. So we're going to give you 2 years to relocate your supply chains either closer to the United States, friendshoring or onshoring, and open factories in the United States. We're going to give you a 2-year runway. And if you opt to not take that time and move your supply chains to the United States, well, then we're going to tariff you. That's not an instantaneous overnight inflationary act. And I think that is probably going to be where cooler heads do prevail. And again, these are matters that have to be also taken up by Congress, where there's a very thin majority that we know to be in the House of Representatives, and as well as some fairly conservative, fiscally conservative, trade-friendly leaders in the new Senate.
Yeah, I think we're certainly dealing with a lot of uncertainty at the moment where things can change. So thank you for bearing with me on all of these questions. I also wanted to bring up another point. So I've heard you say elsewhere, it looks like we are already in a recession in the US at the moment. So I'm wondering if you can go into that. This is another thing that seems to be something that takes time to play out. We don't know that we're in it until after it's already happening. So where are we with that? And also on the note of recession, can we even know at this point, is it looking like it's going to be short or long, very severe or not? What are your thoughts?
So two things here. We know that in April of 2024 that a threshold was crossed, that the level of unemployment in the United States had risen by 10%. So we kind of crossed over that boundary this last April. The United States tends to be in recession when the level of unemployment rises by 10%. We don't have final figures in the year ending March the 21st, 2024. We know that there was a negative revision of 818,000 to payrolls, private payrolls that were initially announced as being 2.4 million jobs created in the private sector in the year ended March the 31st. We now know to be, with one round of major revisions, down to 1.4 million jobs created over that 12-month period. So that shaved off a full million. But what we don't have in hand yet is the second portion of what's called the birth death model. All we know are the figures on companies that were created over that time frame, as opposed to what we're going to get in the next few months, which is finding out the number of companies that died, the death part of that. So we know that the figures are going to be coming down even more than they already are. July, August payrolls, they were very weak. We've seen negative revisions to private payrolls for 19 months running now. And even though there may be kind of a bump up in the November figures, I don't think we'll have anything definitive in hand looking back until we have more and more revisions in hand. A very easy and quick way to explain when Americans find out that we've actually been in recession would be to look back at the first quarter of 2001 and to look back at the first quarter of 2008. It was 5 quarters before we found out that what was originally reported as a positive GDP growth figure had actually been revised down to a negative figure 5 quarters later. So you're right. There is a very long lag time but the time we actually find out what reality was looking in the rearview mirror. So as to whether or not it's going to be a long recession, if it did start in April of 2024, I don't really see a contraction ending early on in 2025, simply because a lot of states and local governments that have been responsible for more than 50% of the hiring in the last 12 months or so, they've run out of their COVID funding. So I think that the impetus, the ability to cushion layoffs in the private sector by creating jobs in the public sector, I think that has been exhausted. And so we're not going to have that going forward. So that could theoretically prolong a recession. And again, a lot of individuals in corporate America are waiting for the household credit cycle to cycle through. We're seeing a continuation of increasing auto loan defaults. Credit card delinquencies are just now picking up. For the first time at the end of this year, individuals, it's estimated to be about 20 million Americans who've not been paying on their student loans since March of 2020. They'll be reported to the TransUnions and the Experians of the world for the first time at the very end of this year for being delinquent on those loans. And as long as you have a continued degradation on the household balance sheet side, the ability to increase revenues is going to be impaired. And that, again, is going to trickle through to what we started talking about, and that is whether or not the CEOs and the CFOs of the world are confident enough to stop firing, put a pause, hiring freeze, and then flip the switch all the way back onto hiring. So these are processes. They take time. We could easily, be out of recession by the middle of 2025, but not necessarily feel it because unemployment is the most lagging of economic indicators, and unemployment tends to stop rising when you're already in recovery. So lag. I know there's no real satisfactory answer that I can provide you, but all we have to go off of is history.
I think it really does help to have the context, though. So appreciate you going into it and just talking about things that are bubbling under the surface. Maybe you don't see them coming till later. I keep thinking back to the bank failures that we had last year, and that seems to be something that was a big problem, and we've mostly forgotten about that. Is that something that you're concerned about? Should we be looking for more of those to happen? Any thoughts there?
So we have seen a steady increase in banks extending and pretending their commercial real estate loans. And in fact, Moody's put out a report that raised a red flag because now we're starting to see second defaults on one loan that has been extended and pretended in the commercial real estate world and redefault. So banks are running out of time in terms of recognizing losses in their commercial real estate books. We know that the Federal Reserve, we just talked about this, is taking its time in terms of lowering interest rates. So the same impediments that banks had in terms of being solvent, in other words, the losses that they're carrying on their treasury holdings or on their mortgage-backed securities holdings, they really haven't declined very much. But at the same time, we're starting to see higher and higher loss severities, whether you're talking about an office building trading for 67% lower than what the loan was out on it, or now increasingly lodging. Retail, we've talked about, we've had more retail closures and restaurant closures than we've had openings in the United States in 2024, which is actually an unusual dynamic. And so we're going to have to see how this filters through to bank balance sheets, because there's a good $3 trillion of debt on bank balance sheets associated with commercial real estate. It's not enough to bring the system down, certainly, but it is, I think, something that should keep in 2025 bank insolvencies on our radar.
Okay, so we've got many points to keep an eye on here. Very complex situation and a little bit chaotic, I think. And I mentioned to you before we turned the camera on, our audience is very interested in gold. And you would think that in this type of scenario, we'd have gold doing very well. And of course, the price is historically high, but since the election, we've seen it pull back. I know there's been US dollar strength that's been keeping it down, but wanted to get your thoughts on gold as well and what you think is going on with that dynamic there.
Well, so a lot of people fashion me as being a perma bear, or she's been calling for recession for all of these years. And, my stock answer tends to be, well, when you throw $20 trillion into an economy, you might have a little bit of a buffer zone in terms of fiscal spending. And we actually had direct stimulus to households in the form of the employee retention credit and the Paycheck Protection Program and the EIDL loans. There was a $1.5 trillion alone in cash that was handed out. But my point to you is, because we're having a longer lag than we normally would in terms of recognizing the recession, and I do think that will certainly be called, we've had also a longer lag time in terms of people outwardly needing to hold gold as a diversifying asset. I think that a lot of the rush into gold was also accompanied by a rush into cryptocurrency, and that the two trades were kind of running hand in hand for a while. That seems to have dissipated after the election. But nevertheless, if you're speaking specifically about gold, and we're talking about how long this recession might last, then I think the appeal of gold will be very apparent and obvious going forward, and that we've probably just simply hit a bump. I would also say, though, for investors, that if to the extent that they're going to be exposed to the stock market, they should also be focused on companies that behave like gold, that are defensive in nature, that have really strong cash flow streams and are able to maintain their dividends and provide safe harbor when other riskier asset classes don't do the same.
This is kind of exactly where I wanted to go before I let you go. I think a lot of people are looking at what's going on, all the different changes that we've seen in recent weeks, and they're wondering, okay, how do I adjust my portfolio? What can I do to kind of get through this storm and hopefully profit as well? Any final advice you would share on that note?
So I think that we're in an environment where you want to be very protective of having a return of your assets. There are certainly ways to expose yourself to risk. I don't have to list them. But by the same token, I would certainly suggest being a little bit more defensive in posture right now. It's no mistake that on the same day that Jay Powell took to stage and talked about inflation coming down slowly on the glide path, that we saw money market fund assets cross the $7 trillion line in assets under management. So despite the fact that the Fed is lowering interest rates, we're seeing investors crowd into the safety of cash. I don't believe in coincidences, and I don't think that that's a coincidence at all, despite the fact that the Fed has taken interest rates down by 75 basis points already. So to the extent that we should pay attention to what people are doing as opposed to what they're saying, it looks like they're trying to pare back their risk exposure by increasing their cash holdings, despite the fact that they're getting a lower level of an income stream, interest stream off of that.
Okay, that definitely makes a lot of sense to me. And just before we wrap up, any final points that you are keeping an eye on in general that you would encourage investors to watch?
So I think investors should be aware of the fact that we really haven't seen a full ratcheting back in volatility measures. And I don't think that is going to happen to the extent that you want to be quote unquote long volatility, I think that that's still a very viable place to be going forward, because I don't think that even though inflation may be coming down on a bumpy path, I think that the future for risky assets is going to be even bumpier. And that therefore being exposed to volatility however you can is not necessarily a bad way to kind of hedge yourself going forward for what can be more volatile times ahead.
Okay, well, thank you so much for taking the time on a very busy day to go through all this. It was really great to have you.
I appreciate your time as well.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Danielle DiMartino Booth.